Have you ever wondered why the price of a new smartphone is sky high when it's first released, but drops months later? Or why gas prices can shoot up almost overnight? The answer to these questions lies in one of the most fundamental concepts in economics: supply and demand. It's the invisible hand that guides the market, influencing the price of everything from your morning coffee to the value of global stocks. Today, we're going to break down this powerful force so you can understand what really moves market prices. So, what exactly are supply and demand? Let's keep it simple. Supply is the total amount of a specific good or service available to consumers. Think of it as how much of something is out there for people to buy. Demand, on the other hand, is how much of that good or service consumers are willing and able to buy at a certain price. It's all about how much people want it. These two forces are in a constant dance. When they're in balance, prices are stable. But when one changes, the other feels the effect. And that's when prices start to move. Let's talk about what happens when demand skyrockets. Imagine a limited edition sneaker is released. Everyone wants a pair, but there are only a few hundred available. What happens? The price goes through the roof. This is a classic example of high demand and low supply. When more people want to buy something than there are items available, buyers are willing to pay more to get it. Sellers see this and raise their prices accordingly. In financial markets, this happens all the time. If a company reports unexpectedly high profits, positive sentiment drives more investors to want to buy its stock. This surge in buying pressure or demand pushes the stock price higher. Let's go back to our sneaker example. Imagine the company decides to mass produce that same limited edition shoe. Suddenly, they're available everywhere. The initial hype is gone, and the market is flooded. To sell all those extra pairs, the company will likely have to lower the price. This is high supply and stable demand. When there's more of a product than people want to buy at the current price, sellers must reduce prices to attract buyers and clear their inventory. In trading, if a country announces it has significantly increased its oil production, the global supply of oil increases. With demand staying relatively constant, the price per barrel will likely fall. So, if prices can go up and down, where do they eventually settle? This brings us to a crucial concept: market equilibrium. The equilibrium price is the sweet spot where the amount of goods sellers want to sell is exactly equal to the amount of goods buyers want to buy. At this point, the market is cleared. There are no shortages and no surpluses. Think of it as a tug of war where both sides are equally strong. But this balance isn't permanent. As we'll see, market forces are always at play, pushing and pulling these curves and creating new equilibrium points. Markets don't operate in a vacuum. External factors constantly shift the supply and demand curves. A major news event, like the announcement of a new government regulation, can instantly change investor sentiment and affect demand for certain stocks. A political event or conflict in a key region can disrupt a supply chain, reducing the supply of a commodity like oil or wheat. Even something like an unexpected company earnings report can cause a stock's demand to soar or plummet. Successful traders understand this. They don't just look at the price. They analyze the broader market indicators and news to anticipate these shifts before they happen. Understanding these concepts is one thing, but seeing them play out in real time is another. That's where having the right tools becomes essential. Platforms like MyMaMarkets are designed to give traders a competitive edge. They provide a comprehensive suite of tools, from advanced financial charting to live market analytics and economic calendars. With these resources, you can track price movements, identify trends, and see how economic data releases and news events impact the market as it happens. This allows you to turn market data into actionable opportunities and execute your strategy with precision. Supply and demand is more than just a theory. It's the engine of the market. By understanding how these forces interact and what causes them to shift, you can move from being a reactive trader to a proactive one. You'll be better equipped to anticipate price movements and make informed, strategic decisions. Ready to put your knowledge to the test? Visit MyMaMarkets to access the tools you need to navigate the global markets with confidence. Thanks for watching.